All right, let's dive right into this. When you hear the name Equifax, I'm guessing your mind immediately jumps to your personal credit score, right? Or maybe you're thinking about that incredibly frustrating time you had to freeze your credit. But if we pull back the curtain for a minute, Equifax is not just that traditional consumer reporting bureau anymore. It has quietly transformed into a massive AI-powered B2B data engine. And right now, Wall Street is pricing this company like an absolute powerhouse, with its stock commanding a massive premium multiple. But as a focused learner, you know we don't just take market enthusiasm at face value. So in this explainer, we are going to tear down the AI Investment Memo on Equifax to see what is really driving the company today.
So the crucial question we're investigating today is this. Is their proprietary data moat actually worth that premium price tag? Because that is the central thesis of this entire investment memo. We need to figure out if Equifax's incredibly deep integration into the daily workflows of banks, mortgage lenders, and employers is enough to offset its lingering cybersecurity trauma and some very real rising regulatory threats.
Section 1. The proprietary data moat. Let's get right into how they actually make their money today.
Looking at this revenue breakdown, it completely flips the traditional narrative on its head. Their U.S. information solutions, which includes all that traditional credit reporting you're familiar with, makes up roughly 34% of revenue. But the real heavyweight here, that's workforce solutions, coming in at over 42%. This segment has quietly become the true, highly profitable economic engine of the entire company. It's powered by a platform called The Work Number, which is essentially this massive payroll database holding over 800 million active and historic employment records. Think about that scale. When a lender or an employer needs to verify your income, they ping this database, and Equifax charges a transaction fee. It is a highly scalable, incredibly sticky business model.
Section 2. The margin paradox. Digging into the financials, we find a really fascinating tension between growth and profit.
Well, if you just look at the top line, things look fantastic. Looking at this steady climb, you can see operating revenue has marched upward over the last 5 years, reaching roughly $6 billion by fiscal year 2025. This steady top-line growth is exactly what you want to see as an investor. It's driven largely by that incredibly strong workforce solutions engine we just talked about, along with some really resilient mortgage and international growth.
But here is where the paradox emerges. Contrast that beautiful revenue climb with their operating margins, which have actually compressed significantly. We're talking a drop from over 23% in 2021 down to roughly 18% by 2025. You might be wondering, why is profitability taking a hit while revenue grows? Simply put, running this massive data empire has become incredibly expensive. They are absorbing huge, centralized technology and corporate security costs. They are migrating to the cloud and constantly patching the castle walls. It just costs a lot more to be Equifax today than it did a decade ago. And that margin pressure bleeds right into their cash flow. Notice the historical volatility here, specifically that sharp dip in free cash flow back in 2022. For anyone looking to invest, that kind of volatility is a glaring red flag. When you're trying to value a company, you really rely on underwriting a predictable, normalized stream of cash. Wild swings like this make it very difficult to confidently justify a premium stock price, which naturally brings us to the forces causing all this friction in the first place.
Section 3. The Threat Matrix. Let's explore the structural downside risks that are actually squeezing those margins.
Okay, you literally cannot talk about Equifax without talking about 2017. That severe cyber breach wasn't just a one-time PR nightmare. Honestly, it was the financial gift that kept on taking. It triggered a long, agonizing, and incredibly expensive aftermath. I mean, we are talking about global settlement agreements, a consumer settlement that didn't even become fully effective until 2022, and massive financial penalties, including up to $575 million tied to the FTC alone. But more importantly for the future of the company, this event structurally raised their ongoing compliance and technology costs. They are living under a permanent regulatory microscope now, and consumer complaints across the whole industry are rising sharply.
Beyond that cyber hangover, there is a massive policy threat looming in the mortgage market. Right now, when you go get a mortgage, the industry standard is a tri-merge report. That means the lender pulls data from all 3 major bureaus, Equifax, TransUnion, and Experian. But regulators at the Federal Housing Finance Agency are actively discussing a shift to a bi-merge system, which would require data from only 2 bureaus. If that policy shift happens, it could structurally impair Equifax's transaction volumes. It's simple math, right? If lenders suddenly only need 2 reports instead of 3, Equifax is at serious risk of being the odd man out on thousands of daily transactions.
Section 4. The final verdict. Let's pull all these threads together and look at Equifax's valuation scenarios.
So let's talk numbers. As of the writing of this memo, Equifax is trading at roughly $180 a share. But when you compare that $180 price tag to our intrinsic value scenarios, it reveals a pretty stark contrast. Even in a solid base case scenario, which assumes good growth and modest margin improvements from their cloud investments, the intrinsic value is calculated at just $136. To justify that $180 price, you have to assume absolute, near-perfect bull case execution. The market is essentially pricing in zero policy mistakes, no macro slowdowns, and massive success from their AI initiatives. And if they stumble into the bear scenario, say mortgage regulations do change and compliance costs stay high, investors are exposed to a massive 30 to 50% drawdown.
Looking at this base case sensitivity curve, you can really see the danger of that premium price. Notice how steep that drop-off is. The valuation is highly sensitive to macroeconomic factors totally outside of Equifax's control. We're talking things like mortgage policy stability, terminal cash margins, and interest rates. When a stock is this sensitive to external shocks, paying top dollar leaves you with very, very little margin of safety.
Which brings us to the final recommendation from the investment memo. Underweight, or just avoid it as a new core holding right now. The smart move, according to the analysis, is to wait 12 to 24 months, let the dust settle on these mortgage workflow policies, and wait for actual, tangible proof that their AI and cloud investments are expanding margins rather than just draining cash. Look, Equifax has undeniably built an incredible, highly profitable data moat, particularly in workforce solutions. But it leaves us with this final, provocative question. Is paying absolute top dollar for a data moat really worth it when the castle walls are constantly under siege from regulators and cyber threats? Think about that as you evaluate the data landscape. Thanks for joining me on this explainer, and keep learning.